Are you confused about loans and how they work? You're not alone. They're great if you know how to use them, and stay tuned for a hack that I'm going to show you at how you can get 0% interest on your loans for life. So loans can be a great financial tool if you know how to use them properly. Let's break down a few of them. There are loads of different types of loans out there. There are personal loans, business loans, student loans, mortgages, they're a type of loan, and loads more. And every single one's got a specific purpose with specific rules and even language and terminology used within them. But we're just going to keep it simple here. When you take out a loan from a lender, they're giving you money. And in return, you promise to pay back all of that money, the principal sum, some language there, some terminology, and you're going to pay a rate of interest for the privilege of being able to lend that money. Now, depending on the lender, that can be a small amount of interest, usually commercial banks, high street banks, versus a high amount of interest on credit card debt, for example, or even ones that you shouldn't do, and I totally don't recommend this at all, loan sharks. Now, I just alluded to it, but the amount you borrow is called the principal amount, and the interest is the borrowing cost of that money. At the beginning of the loan is when you pay the most interest, and as you can see over time, the interest payment reduces because the amount of interest you're paying on the principal is coming down. So you can see that typically as you get to about halfway through the loan, depending on your time period, you then start to eat away at the principal amount. So therefore, by the end of the loan period, you've actually paid back the entire amount. This is called amortization. So amortization is nothing more than an accounting word, and it basically means gradually writing off the initial cost of an asset to the end when you come to the end of the loan period. If you look at it in terms of buying a house or a mortgage, because of amortization, you'll own your home by the end of the loan term. So if you take out a mortgage with a 25-year term, you've got your interest you have your interest rate, and you've got the term of the mortgage, which you just said is 25 years. At the end of that 25-year period, even though you're being charged interest throughout, you'll still own your own home at the end of the term, and this is because of amortization. Now, it's really important to understand the terms of a loan, and this is normally written in the agreement or the loan contract, and usually, as you can see here, I'm making light with the Willy Wonka video, but it's very important that you read these contracts at least once, start to finish. As you become more familiar with borrowing, you'll see that legal terms are generally the same throughout, but as far as this video is concerned, read the contracts through and through before you sign anything. So what else determines whether or not you're going to get a high interest rate or a low interest rate? Because we all want the low interest rate, right? Well, it's all about your credit score. You've probably heard about it, and it's this mysterious thing that exists in a place that you can't touch or see, yet everyone relies on it for their information when you're applying for a loan or getting a new mobile phone or any form of credit. In really simple terms, the better your credit score, the lower the interest rate you'll pay. And this is all about risk. So you've got to look at the credit score from the lender's point of view, not your point of view. So if you're the lender and you've got 100 people that want to borrow money from you, great, that's good because it's good for business. It means you can charge interest and earn more money. But what you want to do as a lender, you want to understand out of these 100 people, who's good for it, who's going to make the repayments, who's risky and might be prone to late payments, and who are just like going to take the money and run and not pay me at all. The people at the latter end of that scale, the people that are going to take the money and run because they've got bad credit, they usually have low credit scores. And the people that have got a history in paying back their bills, their mortgages, their phone bills, and so on and so forth, they usually have higher credit scores. And the thing with these credit reference agencies, and there are many around the world, but there are two large ones which I'll come on to in a second, is every single financial institution uses them to assess your lendability. I would absolutely recommend you check your credit score with at least one of these agencies. It's unlikely they'll all be wrong. They'll all have pretty much 99% the same or accurate data about you. So check with one of them. It's usually free, and make sure your data is correct, because if there's something on your credit report that is wrong, it could be costing you in terms of the borrowing you're potentially eligible for or may want to do in the future. Now, the two largest companies out there in both the UK and the US are Experian and Equifax, and I've put links to both of their websites, both the UK version and the US version of each, in the description below, so have a look at that if you want to check out your credit score. And don't forget, when you do take out credit, it's important you make your repayments on time every single month in full, because if you don't, one missed payment appears on your credit score. So defaulting on a loan can have really serious consequences and potentially take you years to recover from going forward. Now, loans are great. They can help you achieve your financial goals. They can help you buy new cars. They can help you invest in assets. They can help you or will help you get a mortgage. So really treat them as good things if used correctly. Don't take loans out for bad debt, things that are really not going to pay dividends in the future, or even short-term fixes. They're not great for that. Really try and build up a pot of savings for any short-term emergencies. So the bit you've all been waiting for, how do you borrow at 0% on your loans for life? Well, and just to be clear, this is not financial advice. Right, so lean in, don't tell anyone. What you're going to need for this is 2 credit cards. So already you're going to need to have reasonably good credit in the first place to start this process. But if you've got 2 credit cards, we're off to the races. On all credit cards, you normally use them for making purchases, and at the end of the month you repay that. And if you do that, normally there's no interest fee to pay. But what credit cards also allow you to do is withdraw cash at 0%. And again, as long as you repay it, there's no charge. Typically, if you go over the borrowing period, read the small print in the contract, by the way, then the interest charged on borrowing cash is normally higher. So what you can do then is take out the loan in cash. So let's assume you've got 2 credit cards with a total amount of debt available of £5,000. So each credit card has £2,500 or dollars available on each credit card. And you want to borrow £2,000 at 0%. You withdraw the cash into your bank from the credit card. You'll do this via the credit card's app or on the credit card's website. Into your bank account. Fantastic. The clock starts ticking. You will need to repay this at the end of whatever the period is, usually 30 days, or they'll start charging you money. What you then do is on the other credit card is you do a balance transfer from the first credit card onto the new credit card. And the beauty of this, it's quite common that credit cards give you a 0% balance transfer period for up to 3 years in some cases. Now I've done a comparison on credit cards here. Check out this video afterwards in the card in the corner. And there you've got yourself £2,000 borrowed at 0% for up to 3 years, depending on the period on that first credit card. You can thank me later. Now there is normally a balance transfer fee associated with the balance transfer. It's normally 1 to 2%, but again, it depends. Read the small print, check out the details on your card that you've borrowed from. But as long as you respect the money and the process and the credit and what it's there to do for you, you'll have no problems at all in rinsing and repeating this process and using cheap money to fund asset purchases ultimately. Or even better, clearing and paying off expensive debt. Now thanks for watching. Have a look at the other videos on my channel. Like I said, there's another credit card video that I really implore you to watch after watching this, both in the UK version and the US version. And don't forget, no matter what, always start with you.